Private markets have existed for a number of years. You've got pension funds, you've got sovereign wealth funds, you've got insurance companies. When yield is not available in public markets, where do they look?
So how do you look at the overall difference when it comes to looking at private credit versus public markets?
Private credit does not offer the same kind of liquidity that public markets do. Private credit are more bespoke in nature. You are giving up liquidity, but you're getting liquidity premium for that. A lot of large corporations, large conglomerates, there are some big names in India who've been accessing private credit for various purposes. Manager due diligence becomes extremely important.
AI being widely used, is that really reshaping decision-making, portfolio management?
We see the adoption of AI increasing in the years to come. You have to have that human element. You can't have a cookie-cutter approach when it comes to private markets. Mitigation strategies may not work at all times.
One piece of advice that you'd give a first-time investor in private credit? Over the years, we've seen private markets evolve significantly and now account for trillions of dollars in investments as it continues to expand its footprint across sectors and investor classes. It's against this backdrop that we're joined by Sanket Sinha, Managing Director and CEO of Global Asset Management at Lighthouse Canton, to unpack how private markets are evolving and what this means for investors who are navigating a challenging global landscape. Welcome to the next episode of Lighthouse Canton's Ideas. Let's get straight to it. Thank you so much, Sanket, for joining in. Private market transactions date back eons of years, but if we look at it becoming mainstream, that has only been fairly recently. But if we were to date back, say, 25 to 30 years globally in an era of falling interest rates, what would be your outlook on how there has been this systemic shift in private credit transactions and private investments?
So thank you so much, Avan. Private markets have existed for a number of years. I'm no historian of capital, but if you ask me, they have existed for the last 2,000, 2,500 odd years. In the last 25, 30 years, there are few things which have happened. And these things have provided tailwinds to private markets at an overall level. One, of course, is falling interest rate. But if you look at the last 12 years, or maybe I would say last 15 years, post-global financial crisis, interest rate between 2008 and 2021 hovered between 0% and 3%. It's only after COVID that the interest rate went beyond 3.5%. In low interest rate environments, there are investors, institutional investors who are seeking yield because they have defined liabilities. To name a few, you've got pension funds, you've got sovereign wealth funds, you've got insurance companies. And when yield is not available in public markets, where do they look? They look at private credit, they look at private markets. So that's one of the factors. When you look at private equity, what has happened in the last 25, 30 years, advent of technology. There are a number of technology companies which have come up which are asset light. Now, who would fund these companies? It's private equity, venture equity. So the advent of technology as a sector has also led to a strong demand of private capital. And that's led to the growth of private equity / VC over the last 25, 30 years. Let's talk about economy at an overall level. There has been economic growth. There has been infrastructural development. There has been more demand for real estate. Now, real estate and infrastructure, it's very difficult to put them in a public market structure unless there's scale, because valuation associated with these kind of asset classes is difficult to derive. Therefore, it's best that these transactions or these kind of asset classes are wrapped in a private structure. And that's the reason why infrastructure and real estate have done well over the last, I would say, 25, 30 odd years.
Sure.
So broadly speaking, It's the economic growth, advent of technology as a
Yeah.
sector, low interest rates. These are the factors that have driven the growth of private markets.
Okay, so you've summed it up quite well in terms of what has led to this advent. And the fact that I would think the global financial crisis, I think, was a bit of a turning point as well. Now that private credit is on its way to becoming a $1.8 to $2 trillion industry, what do you believe is making it such a compelling investment opportunity?
Again, coming back to the same point, low interest rates. We are in a 4% benchmark interest rate regime, give or take, at this point in time. The expectations are the interest rates would go lower. Yield investors, they have to look at private credit. You don't have higher yields available in public markets anymore. Post global financial crisis, there are a few things which have happened. One, as I said, between 2008 and 2021, interest rates hovered between 0 and 3%. So low interest rate is one factor, but there has been a lot of regulatory changes as well. You talk about Basel III, you talk about Dodd-Frank. Banks have retrenched from your typical mid-market lending. Banks have focused largely on investment grade, good quality borrowers. When it comes to mid-market lending, when it comes to sponsored financing, or when it comes to originate to distribute kind of strategies, you're typically CLOs and CDOs. These were all originate to distribute products, right?
Right.
Those products have dwindled post GFC because of increased or heightened regulation. And that has again provided tailwinds to private credit as an asset class. Now, we believe we don't see regulations becoming easier going forward.
Okay.
Regulations will keep on becoming more and more stringent because there's a wider participation in capital markets that's happening from investors beyond institutions. You've got family offices, you've got retail investors who are participating. And given that there's a broader participation in capital markets, you expect the regulators to keep on becoming more and more stringent when
Yes.
it comes to the quality of products which are hitting the capital markets. Therefore, we believe that private credit uh, will have better days in the years to come.
Okay, and the regulatory landscape is becoming more stringent, which is a good thing, of course. So, Sanket, if we were to look at the entire spectrum of private credit, there are, of course, different types of products. If you could just break it down for us and explain them.
So, if we talk about the entire spectrum of private credit, it would start with direct lending, where a fund is essentially providing direct lending to a company which is an operating company. In India, it's popularly known as performing credit. Direct lending is more of a North American term. When you look beyond performing credit or direct lending, you would be doing special situations, you have distressed, you've got something called growth debt. Special situations is where you're doing more of corporate action led lending, or let's say there's a company which is looking at acquisition financing that would fall within the special situations bucket. Distressed is more of a situation where the company is going through a period of stress and is looking at rescue capital. So rather than equity, you structure it as a debt, and that's what distressed lenders typically do. Growth debt is essentially providing debt capital to companies which are part of growth sectors, let's say technology. Now, technology companies are asset light, and they would not really fit the bucket that a typical bank would look at when it comes to lending. And that's why they have to look at alternative growth lenders to meet the requirements. So this is broadly the entire spectrum of private credit, and these are different kind of private credit products which are available in the market right now. A number of these products have increasingly become popular in India as well. While if you look at the genesis, most of these products picked up in North American markets, then in Europe, but now they are becoming popular. Most of these products are becoming popular in India as well.
So, how do you look at the overall difference when it comes to looking at private credit versus public markets? And if you could just outline from liquidity, etc., what the marked differences are?
So, one thing is for sure, private credit does not offer the same kind of liquidity that public markets do. There is, you have to be invested for a period of time. And for investing in an illiquid product, you get something called illiquidity premium. So, whereas a public credit strategy would be delivering, let's say, 8 to 10% in rupee terms in India, you can expect to make anywhere between 12% to 16, 17%, depending on which private credit strategy you are investing in. And that comes from the illiquidity premium that you're able to get. Now, there are a couple of other big differences which are there between public credit and private credit. One, private credit are more bespoke in nature, which essentially means that you're able to get better quality security structure, you can get better governance, you are able to bilaterally negotiate. In a public credit transaction, as an investor, you don't have the opportunity to bilaterally negotiate directly with the borrower. So that's one big difference. The second is volatility. In public credit, the prices of bonds, the prices of non-convertible debentures would move up and down depending on various factors. One factor could be interest rates, benchmark rates going up and down. The other could be credit risk premium, which can move in a very volatile manner in times of dislocation. In private credit, you don't have that sort of volatility because the loans, the underlying bonds or the underlying non-convertible debentures are not being marked in the market that frequently, and therefore the volatility is low. So that's again a third difference, that low volatility is largely because of the fact that these bonds or these loans are not being traded publicly. So that's the third difference between public markets and private markets.
Okay.
So as an investor, you are giving up liquidity, but you're getting liquidity premium for that. You don't get the same kind of volatility. That's a good thing for you. And you get transactions where your manager is bilaterally negotiating a different sort of security structure or a different sort of covenant package, which won't be available when it comes to public credit.
Okay, so those are the marked differences. And, if we look at the recent data as well, it indicates that, big giant corporations, be it an investment giant, we've seen a software company, they have turned to private credit for $5 billion plus worth transactions. What do you think that signals when it comes to the overall perception of private credit?
See, private credit is becoming mainstream now.
Yeah.
If you talk about numbers, there is, give or take, 1.8 to $2 trillion of deployment of private credit that would have happened in the last 12 months or so. Now, there are a number of established companies who are looking beyond public markets to meet their requirements. You spoke about a tech giant. There was a $27 billion trade which happened a few months ago, where a tech giant partnered with a large private credit manager to come up with an off-balance sheet structure for their data center requirement. Now, they could have easily gone to public markets and probably raised at a cost which was lower than what they are paying for this private market transaction. But then they were getting certain benefits out of it. If they would have gone to public markets, they would have likely had to do a balance sheet borrowing. Through a private credit structured transaction, they were able to keep the risk off balance sheet. Now, there are different needs that corporations have at different points in time. Public markets or banks may not be able to meet those needs. That's where private credit players come in with a structured solution, and they are able to meet the requirements that even large corporations have. So private credit is not just about mid-market or, let's say, growth companies. A lot of large corporations, large conglomerates, there are some big names in India who've been accessing private credit for various purposes. So it's becoming mainstream because you have the ability to structure transactions which may meet your other requirements, not necessarily pricing at all points in time.
So like you said, Sanket, it is becoming a lot more mainstream, but one can't deny the fact that there are still a few challenges. Rising defaults, for instance, hidden leverage and, governance lapses, and that's been highlighted in some recent fraud cases. Especially in Asia and in India, where access and transparency remain a bit uneven, what do investors need to be most cognizant of in terms of risks, and are we now overcoming them?
Sure. I think this is one of the most asked questions, at least a question that I've been dealing with over the last couple of months from a number of investors.
Great. So I think we'll get it all out in the
Yeah.
open.
So, look, there is a lot of capital that's gone into private credit. As a result, uh, there has been loose lending in certain markets, in certain situations. And it's obvious. I mean, it's not just about private credit. When you have a lot of money going into public credit, you're going to see loose lending there as well. When you have a lot of money going into banking system, you're going to see uh, lending becoming looser even in the banking system. So it's not just about private credit. Now, one thing that investors would face as a challenge is the fact that most of the private credit managers, although they may be regulated, but private credit as a product is not highly regulated the way banking products are, or the way public
Yes.
markets are. So manager due diligence becomes extremely important. You have to be able to look at the track record of the manager, the track record of the people who are part of the management team, and what kind of investments they've made in the past, what is the kind of returns that they've generated, what are the kind of people that they've been lending to, what kind of defaults they've had. I think due diligence becomes extremely important. We believe that over a period of time, and as managers, we are preparing for increased regulation even in private markets. That would happen. Uh, as I said sometime earlier, private markets and private credit in particular becoming mainstream. And when you have people coming from the retail segment, or when you have people coming from the mass affluent segment, or let's say wealth segment, when they are participating, it means that there's a broader participation that's happening. It's becoming more mainstream, and regulators would come in and they would want to have some checks or the other. And we see that trend building up as we move forward. But at an investor level, it becomes extremely important to do manager diligence well. So that's what I would say to the investors.
Absolutely. And I reckon that would be true to any asset class, but of course in private credit in particular. And now with AI being widely used, becoming the buzzword, is that really reshaping decision making, portfolio management when it comes to private credit, and how so?
Still early days. People are using AI. We are using AI for a number of end users. There are use cases like going through lending documents of a particular borrower. Let's say if there's a borrower who's already got borrowing from a number of banks or other private credit lenders. We would like to understand what kind of covenants are there, what kind of restrictions are there. And instead of going through 100 pages of loan documents, we have started using AI to understand what the key terms are. We are using AI for portfolio monitoring as well. I mean, we've got an enterprise version of one of the top three generative AI platforms in the world. We've been using that for portfolio monitoring as well. But I would say these are early days. We see the adoption of AI increasing in the years to come. Another use case that we are using AI for is preparing investment memo, at least the skeletal part of it. At the end of the day, what it comes down to today is, while you can do everything with AI, you need people to be checking and double checking the output which is coming out of an AI platform. You can't completely rely on the platform.
Okay.
There are still
The human
times
element
the
is
human
integral.
element is needed, because there are still times when AI platforms could be hallucinating. The
Okay.
output could be very different from what you would expect.
Right.
So you cannot completely leave it on AI. You
Yeah.
have to have that human element, but it enhances productivity. I mean, something
100%.
that would take 5 hours is probably taking 1 hour now.
Yeah.
So we are seeing productivity gains coming out of AI, but I would say that we are still early in the cycle, and we expect the gains to increase tremendously in the years to come.
Okay. And final question, which are the emerging sectors that you see a lot of interest for private credit within? And given that we're still underpenetrated in private credit as compared to the other economies like the US and Europe, how do you see the future of private credit in India especially?
So private credit is mainstream. There are many sectors where companies are accessing private credit. But if you ask me what the broader trend is, and this would be true for most private asset classes, whether it's private equity or private credit or venture equity. I would say AI-driven industries. I mean, the way
Yeah.
at which, the pace at which, AI adoption is happening, we would need more data centers. We would need energy-efficient data centers. So AI definitely is going to be a big game changer, and you're going to see a lot of demand for capital coming from AI across private assets, whether it's equity or credit or even infrastructure/real estate. The other big theme that we are seeing right now is climate change, and the emergence of generative AI is just going to increase the emphasis that investors, managers have on climate change, as a theme, because the kind of computing power that is needed for generative AI, it's just increasing the demand for power. I mean, but people are already talking about it, and they expect that there would be a lot more demand for power to
Okay.
meet up with the compute power that's needed as AI adoption increases. So climate change is another theme that we believe is going to be a big driver for private markets in the years to come.
Given that you touched upon management, let's talk about what makes a good private market investment team.
A good private market investment team, you need to have people who've got investment acumen. That's needed, and that's needed for any kind of investment. It's not just private markets. But beyond that, you need to have people who've got eye for detail, because you have to go through uh, layers and layers of documents. There are a number of different contracts, and these are bilaterally negotiated contracts. So it's important for people who are negotiating bilateral contracts to have an eye for detail. They need to have structuring acumen, because every transaction is a bespoke transaction. Structuring is required. So it's very important for the team to have structuring capabilities. Structuring leads to the ability to think out of box. You can't have a cookie cutter approach when it comes to private markets. Every transaction is different from the previous one that you did and from the one that you did before that. Therefore, it's important to be able to think out of box and come up with innovative solutions, innovative structures. So I think the ability to think out of box is something that's needed. But the most important is risk management. Look, at the end of the day, you're dealing with illiquids. If something is going wrong, you cannot go and liquidate it in the market tomorrow. Therefore, risk management becomes extremely, extremely important. You need to be able to identify all the risks, have a mitigation strategy even before you're going in. Now, mitigation strategies may not work at all times, but at least you need to have your plan Bs and plan Cs in place. So risk management becomes an extremely important part. So I would say all of these things taken together would form what is needed in a successful team: ability to transact, investment acumen, risk management, and the ability to think out of box.
And be innovative. Yes, absolutely.
Yeah.
All right. Now, Sanket, before we let you go, we've got a quick rapid fire round. So, quick prompt responses that come to mind. Are you ready?
Yeah.
Okay, let's go. One sector you believe will define the next decade of private credit.
Artificial intelligence.
Okay. One word to describe private credit today in India.
Early and a great opportunity.
Okay, good to know. What's the biggest misconception you think people have when it comes to private credit that you want to bust?
High risk.
Okay. And one piece of advice that you'd give a first-time investor in private credit?
Start small.
Okay. Sanket, thank you so much. You've really opened our eyes to this, magnanimous world of private credit and all that it has to offer. It's been truly interesting. The fact that it is becoming mainstream, the fact that now we're looking at a huge spectrum of investing, and you need to have more stringent regulations, as you said. And it's also going to have a solid investment team that it has the ability to think out of the box. And AI-driven industries, really, that's where it's at. So thank you so much for joining in.
Thank you. Thanks a lot.
Lots of key takeaways from this episode. The fact that technology, economic growth, and low interest rates have certainly made private credit a lot more mainstream. The spectrum of private credit is rather wide, and we are seeing now regulations becoming a lot more stringent, which is the need of the hour. AI looks like the hot and up-and-coming sector, And for investors looking to invest in this space, it is important to not have a cookie cutter approach and think outside the box. But of course, risk management is absolutely critical. Hope you enjoyed watching. Do stay tuned. We'll have lots more episodes coming out. Thanks for watching.